Welcome back to the deep dive. Today we're going deep into market predictions
Oh, yeah.
for 2025.
All right.
And we're using Alec Young's recent market outlook report from mapsignals.com.
Okay.
Specifically, we're digging into his predictions for potential gains outside the S&P 500.
Interesting.
And what makes this particularly interesting is that
Yeah.
the S&P 500 is on track for a second year of returns exceeding 25%.
Wow.
So why are we even looking elsewhere?
Well, Young's 2024 predictions were surprisingly accurate,
Oh, really?
especially considering other analysts were only predicting a 1% market upside
Oh,
for the year.
Okay.
So when he suggests looking beyond the S&P 500, we should probably pay attention,
Right.
especially when you consider some of the economic trends he's identified.
Okay. So let's dive into those trends.
All right.
Young uses this catchy phrase,
Okay.
don't fight the Fed that's cutting rates.
Hmm.
He argues that we're experiencing a soft landing
Okay.
for the economy with steady GDP growth and a strong job market.
What's fascinating about this is that this soft landing appears to be influencing the Fed's decision to lower interest rates. Back in 2022, rising interest rates really hampered stock growth.
Oh, yeah, for sure.
But Young believes that the opposite could be true now.
Oh, good.
Lowering rates could stimulate equity prices.
Yes. So he's predicting that the Fed might cut rates
Yeah.
more aggressively than anticipated,
Yeah.
which could lead to another surge in stock prices.
Potentially.
But what about the market anxiety around tariffs? It seems like a lot of investors are worried
Yeah.
about their potential impact.
Young addresses that head on, and he has a rather intriguing take.
Oh, really?
He suggests that the tariffs are potentially a strategic negotiation tactic. His view can be summed up as tariffs talk steel.
Interesting.
It might be a way to achieve economic policies that are less severe than we initially feared,
Okay.
similar to what we saw a few years back.
So it's not necessarily the doom and gloom scenario that some people are painting.
Right.
And remember, markets often react positively when things turn out better than the worst case scenario.
Exactly. Another common fear that Young debunks is the myth surrounding the 10-year Treasury yield.
Okay.
The prevailing narrative is that rising yields make stocks less attractive.
I've heard this argument before. What are the specific concerns driving this fear?
It boils down to two main fears.
Okay.
First, that rising yields indicate anxieties about the national deficit.
Right.
And second, a low equity risk premium suggests that stocks are overpriced compared to bonds.
Yeah.
But Young's analysis counters these concerns with some interesting points.
Okay.
For example, he argues that the recent rise in yields actually mirrors the Citi Economic Surprise Index.
Hold on. What is the Citi Economic Surprise Index?
It's an index that measures the degree to which economic data is coming in better than expected.
Oh, okay.
So according to Young, rising yields might not be a sign of panic about the deficit, but rather a reflection of better than expected economic growth.
So what does this mean for stock investors?
If we connect the dots, rising yields might not be a harbinger of doom, but actually a signal of a strengthening economy, which would ultimately benefit stocks.
Gotcha.
Furthermore, Young points out that historically,
Yeah.
when the equity risk premium is low as it is currently, the S&P 500 has typically seen above average gains in the following year.
So despite what some headlines might scream, maybe the current low premium isn't a red flag after all.
Right.
But what about overall investor sentiment?
Yeah.
Are we in a bubble with everyone overly optimistic about the market?
That's a good question.
Yeah.
Young uses the American Association of Individual Investor Sentiment Survey to address that concern.
Okay.
While there's certainly some optimism out there, the current levels are only slightly above the long-term average.
So no rampant euphoria just yet.
Exactly. And that's why he believes there's still room for the market to grow. This brings us to one of Young's most intriguing points, the potential for bigger gains outside the S&P 500 in 2025.
Okay.
There are several factors converging to create this unique opportunity.
I'm all ears. What are those factors?
Well, remember those rising long-term interest rates we discussed?
Yes.
Young believes they're signaling stronger economic growth on the horizon,
Okay.
which should benefit some areas of the market more than others.
Makes sense. And what else?
He also highlights the political landscape.
Okay.
He suggests that the current economic policies might fuel increased mergers and acquisitions, driving growth in specific areas.
Of course, we can't forget about tariffs, right?
Yes, but remember Young's perspective.
Yeah.
If implemented strategically, tariffs might not have a significant impact on inflation.
Okay.
or completely undermine the current pro-business agenda.
And what about the Fed's easing stance?
That's a crucial piece of the puzzle.
Okay.
What's interesting here is that the easing doesn't seem to be driven by crisis aversion as we've seen in the past. Historically, when the Fed eases rates in a non-recessionary period, small and mid-cap stocks,
Yeah.
or SMID stocks,
Okay.
tend to benefit the most.
And I'm guessing Young has the data to back that up.
Absolutely. Since 1995, after the first Fed rate cut in a non-recessionary environment, both small and mid-cap stocks
Wow.
have consistently outperformed the S&P 500. And given all three indexes are up less than 10% since the September rate cut, history suggests there's still quite a bit of upside potential.
Now, that's what I call an intriguing insight. So instead of just riding the wave of the S&P 500, Young is making the case for these SMID stocks.
Yeah.
But why are these stocks specifically positioned for such growth?
One key reason is that SMID stocks are inherently cyclical.
Okay.
This means they're more sensitive to economic fluctuations and stand to benefit significantly from an economic upswing like the one Young is predicting.
So as the economy strengthens, those SMID stocks are likely to experience a greater positive impact compared to the broader market.
Precisely. He highlights this by pointing out that compared to the S&P 500, SMID stocks have a significantly higher combined weighting in cyclical sectors, like financials, industrials, and discretionary.
Right.
They're essentially a more concentrated bet on economic growth.
So it's not just about the macro environment, it's also the composition
Right.
of these SMID stocks that makes them well-suited for this type of market.
Exactly. And let's not forget about earnings.
Right, earnings. Oh, those are crucial.
Yeah.
What's the outlook for SMID stock earnings?
Projections for 2025 look really encouraging.
Okay.
The S&P Small Cap 600 and S&P Mid Cap 400 are estimated to post 24.7% and 16.7% EPS growth, respectively.
Wow, those are impressive numbers.
Yeah.
But wasn't there some hesitation around the feasibility of those growth estimates before the recent political shifts?
You're right, before the recent changes, investors were a bit hesitant. The economic landscape was uncertain, and they weren't fully buying into the optimistic earnings forecasts, particularly for cyclical sectors and SMID stocks.
So what's changed?
The combination of the Fed's easing and the perceived pro-business policy environment have bolstered confidence in those 2025 earnings projections.
Okay.
Investors are now more willing to believe that these companies can actually deliver on those growth figures.
So it seems like the stars are aligning for SMIT stocks.
It seems that way.
A favorable economic environment, their cyclical nature, and renewed confidence in their earnings potential.
It certainly looks that way. And here's the kicker.
Yeah.
Despite their recent outperformance and these promising earnings forecasts, SMID stocks are still relatively undervalued compared to large cap stocks.
So they're projected to grow faster and they're cheaper. That sounds like a fantastic investment opportunity.
It does, doesn't it? Both the S&P Small Cap 600 and the S&P Mid Cap 400 are trading at a price-to-earnings ratio of 17.8 times their 2025 estimated earnings.
Oh, Sky.
Compare that to the S&P 500's PE ratio of 22.5, and you start to see the potential for considerable upside.
So Young is saying that SMID stocks offer both growth and value,
Yeah.
which is rare to find in the same investment.
It is.
But with so many stocks to choose from, how can investors find the most promising companies in this space?
That's where Young's analysis gets really interesting.
Okay.
He argues that the current market is particularly well-suited for stock picking. And in this market, picking the right stocks could further amplify returns for investors.
Tell me more about this stock picking advantage.
It all comes down to correlation.
Okay.
In finance, correlation measures how closely the movements of different stocks are related to each other.
Right.
When correlation is high, most stocks move in a similar direction, usually driven by major macro events.
So in those high correlation periods, a company's performance is less about its own specific factors.
Right.
And more about the overall market sentiment.
Precisely.
Yeah.
But when correlation is low, as it is now, we see a bigger difference in how individual stocks perform.
Okay.
That means company-specific factors, like those driving innovation in AI or robotics, can have a much stronger influence on a stock's trajectory.
So it's less about riding the overall market wave and more about strategically navigating a sea of individual opportunities.
What a great analogy.
Yeah.
And that's exactly why Young argues that this low correlation environment is a perfect time for stock picking. Investors who can identify companies with strong fundamentals and a unique competitive edge stand to gain a lot.
This is all fascinating. But with thousands of stocks out there, how can investors effectively find those winning companies in this low correlation environment?
Well, Young's firm Map Signals has developed a really interesting approach.
Sure.
They're focused on identifying something they call institutional sponsorship.
What exactly is institutional sponsorship?
It all comes down to tracking the movements of big institutional investors like pension funds and mutual funds.
Okay.
They've developed a system to spot unusual institutional trading volumes, essentially identifying when big money flows into specific stocks.
So they're looking for the stocks that are attracting the whales, the ones who have the resources and expertise to spot winners early on?
Exactly. And by combining their proprietary scoring metric with these institutional trading signals,
Okay.
they can pinpoint companies with strong underlying momentum.
So they're not chasing headlines or following the herd. They're looking for under-the-radar companies that are building a solid foundation for growth.
Precisely. Young even provides some great examples of their past successes with this approach.
Oh, yeah.
Companies like Supermicrocomputer and Celestica, which they identified early on,
Uh-huh.
have both gone on to achieve significant gains.
But the standout story is Appleton, right?
Absolutely. Map Signals flagged Appleton back in March of 2024.
Wow.
And since then, its stock has seen a phenomenal 502% increase.
502%.
Yep.
Now that's what I call a success story.
It certainly is. And it supports Young's overall thesis that while the market outlook in general is positive, there's even greater potential for those willing to venture beyond the S&P 500 and embrace stock picking.
So Young is suggesting that by utilizing tools like Map Signals institutional sponsorship tracking, investors can significantly increase their chances of finding those hidden gems with the potential for huge returns.
Yeah.
But before we get too carried away, let's pause for a moment to reflect on everything we've learned.
Okay.
What are the key takeaways so far from our deep dive into Young's 2025 outlook?
Well, the most important takeaway is probably that the economic outlook for 2025 looks quite promising.
Yeah.
Despite some of the more pessimistic narratives out there.
Yeah, I've seen some of those.
We're seeing signs of a soft landing, a strong job market,
Right.
and continued growth potential.
Okay.
And despite the anxiety about tariffs, Young makes a compelling argument that they might not be as detrimental as some fear.
And let's not forget the Fed's easing stance, which historically has been great news for small and mid-cap stocks in a non-recessionary period.
Exactly. So Young is encouraging investors to broaden their horizons beyond the S&P 500 and seriously consider the potential of SMID stocks,
Okay.
which are poised to benefit from the favorable economic environment, their cyclical nature, and strong earnings projections.
And of course, we've learned about the importance of stock picking in this low correlation market, where individual company performance can differ significantly from the broader market trends.
Right.
So for those willing to do their research and potentially utilize tools like Map Signals 2025, could be a year of exceptional opportunity.
Absolutely.
I like it.
But Young doesn't just start there.
Oh, really?
He also provides a fascinating glimpse into some of the specific dynamics that could make 2025 truly remarkable for investors,
Okay.
especially with respect to a potential resurgence of M&A activity.
I'm definitely intrigued by this idea of an M&A surge. Let's take a quick break and then we'll come back to unpack Young's analysis of this exciting trend. Don't go anywhere. Welcome back. We left off on a bit of a cliffhanger.
Yeah.
Alec Young's prediction of a potential surge in M&A activity.
Right.
What makes him think that 2025 will be such a hotbed for mergers and acquisitions?
Well, he's identified several factors that could create the perfect environment.
Okay.
Remember that strong economic growth we discussed?
Right.
That's a primary driver.
Oh.
Companies are more likely to pursue acquisitions when they're feeling confident about the future.
Right.
They may want to expand market share, acquire new technologies,
Yeah.
or simply capitalize on the growth opportunities that a strong economy presents.
So a healthy economy fuels the M&A engine.
Exactly.
But what else is contributing to this potential M&A surge?
Young also highlights the influence of the current political landscape.
Okay.
He argues that a pro-business environment with its focus on deregulation and tax cuts could make companies even more eager to pursue acquisitions.
So it's all about creating a more favorable climate
Yeah,
for those deals to happen.
exactly. And even though interest rates are rising,
Yeah.
still relatively low historically,
Right.
that makes it easier for companies to finance those big acquisitions.
So all these factors together seem to be creating a perfect storm for M&A activity.
It does seem that way.
And Young's analysis suggests this potential M&A wave could go beyond
Yeah.
the usual suspects. What exactly does he mean by that?
Well, it's natural to assume that M&A activity would be concentrated
Yeah.
among the usual players, big tech companies, pharmaceutical giants,
Right, right.
financial behemoths.
Yeah.
But Young believes that small and mid-cap companies could also be major players in this wave.
That ties in nicely with his overall bullish outlook for SMAD stocks.
It does. He sees smaller and mid-cap companies as potential acquisition targets
Okay.
for larger companies who want to expand their reach, acquire innovative technologies,
Uh-huh.
or tap into new markets more quickly.
So this M&A activity could fuel even more growth in the SMBD space.
Precisely. And for investors, this presents a very interesting opportunity.
Okay.
If you can identify those companies that are likely to become acquisition targets,
Yeah.
you could potentially reap some significant rewards.
That's the kind of insider knowledge I love to explore on this show.
Right.
But how can investors actually identify these potential M&A targets? Does Young offer any tips or insights?
He doesn't provide a specific formula, but he does suggest some clues investors can look for.
All right, I'm listening.
One key factor is a company's financial health. Companies with strong balance sheets, consistent profitability,
Yeah.
and a history of innovation are more likely to attract attention
Right.
from potential acquirers.
So solid fundamentals are essential.
Yeah,
But are there other factors investors should consider?
absolutely. A company's market position is another crucial element.
Okay.
Companies with a leading share in a growing market or those possessing unique technology or intellectual property are often prime targets for acquisition.
So it's about finding those companies with a competitive edge, something that another company would be willing to pay a premium for.
Exactly. And it's also crucial to pay attention to broader industry trends.
Okay.
Are there any sectors experiencing rapid consolidation? Are there new technologies disrupting existing business models?
Interesting.
By understanding these industry dynamics, investors can identify companies more likely to get caught up in the M&A wave.
So it's a multifaceted approach.
Yeah.
Analyzing a company's fundamentals, assessing its market position, and understanding its industry's overall landscape.
Right.
But even with these clues, predicting M&A activity is still a tricky business.
It is. There's no guaranteed formula.
Right.
However, by considering these factors, investors can increase their odds of identifying those companies most likely to become acquisition targets.
Okay.
Now, moving beyond the exciting world of M&A, Young provides some additional insights
Wait.
into sectors and trends he thinks are particularly promising in 2025. This is where his analysis really gets granular and offers a fascinating glimpse
Okay.
into the potential investment landscape of the coming year.
I'm ready to hear all about it. Let's dive into Young's sector-specific predictions for 2025. Welcome back to the Deep Dive. We're wrapping up our exploration of Alec Young's 2025 market outlook.
All right.
Before the break, we were teasing some sector-specific predictions.
Right.
What sectors are piquing Young's interest for 2025?
Well, he doesn't explicitly recommend specific sectors or companies.
Okay.
Instead, he emphasizes the importance of understanding the forces shaping the market
Right.
and using that knowledge to guide your investment decisions.
So it's less about following a specific roadmap
Yeah.
and more about developing a compass to navigate the market landscape.
I
I like that analogy.
Me too. And Young's insights can definitely help calibrate that compass.
Okay.
For example, he's highlighted several macro trends that could disproportionately benefit certain sectors.
Joseph.
Well, remember, we discussed his view on rising long-term interest rates
Yeah.
as a potential indicator of stronger economic growth.
Right.
This could be particularly beneficial to companies in sectors like industrials and materials.
Those companies tend to do well when the economy is humming along.
Precisely.
Yeah.
And then there's the potential for increased government spending on infrastructure.
Yeah.
If that materializes, it could create a tailwind for companies in the construction, engineering, and building materials sectors.
So it's about connecting the dots between these macro trends and their potential impact on specific sectors.
Exactly. Young also highlights the growing role of innovation in driving market growth.
Okay.
He suggests that sectors at the forefront of technological advancement, such as artificial intelligence, cloud computing, and renewable energy,
Right.
could offer particularly compelling investment opportunities.
That makes sense. Investors are always looking for the next big thing, and these innovative sectors are often where they find it.
Right. And while Young doesn't give us a definitive list of must-buy sectors, his analysis provides a framework for identifying areas with significant growth potential.
It's about empowering investors to conduct their own research and make informed decisions based on their individual risk tolerance and investment goals.
Precisely. And that brings us back to the idea of stock picking,
Yeah.
which Young believes is especially relevant in this market environment.
Okay.
He argues that this is a time when individual stock selection can make a significant difference in an investor's overall returns.
And that's where tools like map signals can be invaluable.
Absolutely. Remember their approach of identifying institutional sponsorship.
Yeah.
That strategy can be incredibly helpful in pinpointing companies with strong underlying momentum that may not be on everyone's radar.
So it's not just about chasing the latest headlines or following the herd. It's about finding those hidden gems that are quietly building a strong foundation for future growth.
Right.
But we can't ignore the risks, right? What are some of the potential headwinds that investors should keep in mind as they navigate 2025?
Young acknowledges that there are always risks inherent in any investment.
Hmm.
One potential risk he highlights is the possibility of unexpected geopolitical events. Global conflicts, trade tensions, or political instability can have a ripple effect across markets.
It's the ever-present wild card that can disrupt even the most well-thought-out investment strategy.
Exactly. Another potential risk is a policy misstep.
Right.
We've discussed how much of the current market optimism is based on expectations of pro-business policies.
Right.
But a sudden shift in policy, either domestically or globally, could shake investor confidence and negatively impact market performance.
So even though the outlook for 2025 appears bright, investors need to stay informed, remain flexible, and be prepared to adapt their strategies as needed.
Well said. It's a balancing act between recognizing the opportunities and acknowledging the potential risks.
This has been an incredibly insightful discussion.
It has been.
So we wrap up our deep dive into Alec Young's 2025 market outlook. What's the key takeaway for our listeners?
I think the message is one of informed optimism.
Okay.
While there are always risks, Young's analysis suggests that 2025 could be a very rewarding year for investors who are willing to think beyond traditional approaches and explore those areas of the market often overlooked.
He's encouraging investors to be bold, venture beyond the familiar territory of the S&P 500 and capitalize on the potential of these often underappreciated segments of the market.
Exactly. And remember, it's not just about taking on more risk, it's about being informed, strategic, and making decisions that align with your investment goals and risk tolerance.
Wise words indeed. For those eager to learn more, Map Signals offers several resources, including their top 20 stock list,
Yeah.
highlighting companies they believe are poised for significant growth.
It's a valuable resource for investors seeking to uncover those hidden gems.
And as we enter this new year of investment possibilities, it's a great reminder that the market is constantly evolving.
Yeah.
Those willing to adapt, innovate, and embrace new ideas are often the ones who reap the biggest rewards.
Couldn't agree more.
Thanks for joining us on this deep dive into the world of market predictions.
Appreciate it.
We'll be back next time with another fascinating deep dive to help you navigate the ever-changing world of finance.
Sounds good.
Until then, happy investing.